Assalamu alaikum. This is Dr. Muhammad Amir Khan, and this is my first YouTube video. In this video, I will introduce you to partnership accounting. Before introducing the concept of partnership, I would like to explain the concept and the application of limited and unlimited liability with an example. There are three individuals, Abdullah, Nabia, and Samina, and their total assets are 100,000, 50,000, and 80,000. Abdullah invests 40,000 cash in ABC company, and this transaction will be recorded in the accounting equation as increase in assets by 40,000 and increase in stockholders equity by 40,000. The liability of Abdullah is limited to his investment, that is 40,000. ABC company has a separate legal entity and is liable for its debts. In case the company cannot pay off the liabilities from the company assets, investors' personal assets cannot be used to pay off the liabilities. If the company is liquidated, then the creditors have to bear the burden of the unpaid claims. At the same time, Abdullah formed a partnership and named it Sara Accounting Consultancy Partnership, and the investment by the three partners are 20,000, 50,000, and 80,000 respectively. Let us see how this transaction will be recorded in the accounting equation. The firm's assets are going to increase by 150,000, while the stockholders' equity will be replaced by partners' capital, and common stock will be replaced by individual partners' capital account, like Abdullah's capital account, Nabiha's capital account, and Samina's capital account. In case of partnership, the liability of the investors is unlimited as the partnership firm is not a separate legal entity. In case the firm cannot pay off the liabilities from its assets, the personal assets, in this case Abdullah's investment in shares of 40,000 and 40,000 non-cash assets of Abdullah will be used to pay off the firm's liability. Note that Nabia and Samina don't have any other assets other than the investment in the partnership firm. Now I start with the basic information about partnership. First, I will talk about the theoretical concept of partnership that is important to be considered while recording the partnership transactions, followed by the journal entries in this regard. The good news for CPA aspirants is that it is a part of the CPA syllabus. We start with the definition of partnership. Partnership is an association of two or more persons to carry on as co-owners of the business for profit. The attributes or the you can say the features or characteristics of partnership is that there is an agreement, and this agreement can be expressed in writing or it can be implied by unspoken words or by some other way. The objective of a partnership firm is to make profit, and members must be co-owners. That means that each member has equal rights. Let us talk about the advantages of partnership. And when we say advantages, it means that we are going to compare or there is some reference point. And we are going to compare the advantages of partnership in comparison to a corporation. Partnership allows pooling of resources without complexities of a corporation. That is, it is easy to pool money in the case of partnership. It is easy and less costly to be established as the governmental regulations are not as complex as in the case of establishing a corporation. It is not subject to governmental regulations as a corporation because of two reasons. Number one, the owners are managing the business in case of partnership, unlike a corporation where the shareholders do not manage the affairs of the business. The level of operation of a partnership is too small as compared to a corporation. Partners are able to operate with more flexibility, and the income is not subject to taxation at partnership level. And I would like to elaborate it a little more. Suppose we have a company ABC, the revenues for the year is 75,000, expenses are 50,000, so the income before taxes is 25,000. There are 20% of corporate taxes because a corporation has limited liability and has a separate legal entity. So, suppose the corporate taxes are 20%. So, the income after taxes that is available for the investors is 20,000, and there will be income tax on the investor's income. Suppose it is 10%. So, the income after taxes in the case of company is 18,000. If we have the same situation in the case, same information in the case of partnership, then the income is going to be 25,000, and the income goes to the partners. In this case, there is no partnership taxes. So we also call this as pass through entity. Thus, corporation pays taxes on its income as it is a separate legal entity, while partnership firm do not pay taxes on its income because in the case of partnership the liability is unlimited. To conclude, a corporation income is taxed twice, while a partnership income is taxed only once. So you can see that the net effect for the investor is more in the case of partnership. Now I will talk about two types of partnerships, although there are more than two types of partnership. First of all, let me talk about general partnership. And here each partner is a general partner. It means that the partnership firm is a mutual agency. So each partner is an agent of the firm. They can enter into a contract on behalf of the firm. They can buy or sell on behalf of the firm. They have the right to dispose of partnership interest. They have unlimited liability. They are personally responsible for acts done by the other partners. The life of partnership is limited or uncertain, and this is mainly because of withdrawal or death of a partner. The second type of partnership that I would like to talk is about limited partnership, and in this case at least one general partner is responsible for everything in the partnership and there is at least one limited partner. For example, in the case of Sara Accounting Agent Consultancy Partnership, at least one partner, say Abdullah, is a general partner while Nabia and Samina are limited partners. The advantages of limited partners is that they can invest capital only in the business. but they do not manage the partnership. Their liability is limited because if they have unlimited liability, they are exposing their assets to partnership too. There is no participation in the management, and in some cases, we find the term silent partners in place of limited partners. Limited partnership allow general partners to raise capital without giving up management control. Next, we talk about joint ventures. It is similar to partnership. It is an arrangement of by two or more parties to accomplish a single or limited purpose for their mutual benefits. They just go for one undertaking or one event, and then the firm is dissolved. So the life is limited to that of the undertaking they have agreed upon. The relationship is governed by a written agreement. If you can remember, in the case of partnership, there can be oral agreement as well, but here it is governed by written agreement. Each party is going to participate in overall management, and it is commonly organized as a corporation or partnership. So, when joint venture is different from corporation, or it can be different from partnership as well. Let us talk about the partnership agreement. And a partnership agreement should include the following: first, the name of the firm and the identity of the partners, the nature, purpose, and scope of the business, what are their activities or what they want to do, effective date of organization, length of time partnership is to operate, location of the place of business where they want to operate, provision for allocation of profit and loss. If nothing is stated, then profit and loss will be shared equally. Provision for salaries and withdrawals of partners, rights, duties, and obligations of each partner, and authority of each partner in contract situations, whether each partner can act as an agent of the firm or not. Procedures, plans for admitting a new partner, procedures on withdrawal or death of a partner, procedures for arbitrage or arbitration of disputes. Are the disputes to be resolved by the court or through an arbitrator? Fiscal period of partnership, identification and valuation of initial asset investments and capital interest. We will talk about this in more detail when we do the journal entries. Situation for partnership dissolutions and provision for terminating or continuing the business, accounting practices to be followed, whether we will follow cash basis or accrual basis of accounting, and whether or not an audit is to be performed, as audit is not compulsory in case of partnership. Next, we talk about capital interest and profit interest. Capital interest is the equity claim against the net assets of the partnership. Now, we say use the term here net assets, that means total assets minus total liabilities. Now, Abdullah, Nabia, and Samina have invested 20, 50, and 80. So, the capital interest of Abdullah will be about 13%. For Nabia, it will be about say 33%. And for Samina, it is going to be about 44%. However, the interest in income and losses may be different. They may share profit and loss in the ratio of say 40, 30, 30, or they may be sharing profit and loss in the ratio of 50, 25 and 25. It may be anything that they agree upon. And the partner's capital interest will increase or decrease as a result of subsequent operations. And partners' interest in net income or loss may not be proportional to their respective capital interest. Partnerships basically adhere to GAAP, and this is good if they are looking for loan from the bank. Small or specialized partners may utilize either cash basis or tax basis of accounting. Next, we talk about the partnership equity. If you can remember, the equity section of a corporation includes three sections. It is common stock, retained earning or the ending retained earning, and other contributed capital. But in the case of partnership, we have two accounts, capital account and drawing account. And when we talk about drawing account, this is a temporary account. This has to be closed at the end of the period. Drawings are going to be debited in case if there is a withdrawal for personal expenses by the partners. We will talk in detail when we record journal entries in this regard. Let us talk about the journal entries related to what we have talked about so far. And suppose Nabia and Abdullah formed a management consulting partnership, and the fair value of their investments are given over here. You can see that the two partners, they are bringing in the liability as well, and let us see how we are going to record it. The total revenue earned is 150,000, while the expenses during the same period was 100,000. So the profit is 50,000, and this has to be allocated on the basis of original net capital investment. We will talk about it in a while. During the year, Nabia withdrew 15,000 and Abdullah withdrew 12,000 respectively. So let us see how we record it. First of all, we record the initial investment in the partnership for Nabia. You can see Nabia brings in these three assets, or four assets rather. So increase in assets is always debit, and the total is going to be 77,000. And she also brings in the liability of 6,000. So her net initial investment is 71,000, and this is going to be used to allocate the profit among the partners. Let us record the journal entry for Abdullah's initial investment. He brings in 40, 10, 3 and 15, and he also brings in the liability of accounts payable, and there is a mortgage payable as well. So 68 minus 32, that gives you 36. So that's how we calculate the initial investment of Abdullah. We can see that the two partners, they have withdrawn 15,000 and 12,000, and when they withdraw, so drawing is going to be debit and cash is going to be credit. Next, we are going to see how we close the drawing account. Remember that revenue and expenses are temporary accounts, and they are going to be closed against the income summary account, while the drawing account is going to be closed against the capital of the partners. So the income we have calculated was 50,000, and the initial investment of Nabia was 71,000, and for Abdullah it was 36,000. So that makes 107. So 71 divided by 107 times 50,000 will give you 33, and then 36 divided by 107 times 50,000 gives you 16,822. The drawing, as since it is a temporary account, it is going to be closed, and it is going to be closed against the capital accounts of each partner. So capital account is going to be debited and the drawings is going to be credited. Finally, let us see how the net capital balance of Nabia and Abdullah are going to look like at the end of the period. Their beginning investment was 71 and 36. The firm has generated a profit of 50,000 that is distributed in the ratio of their initial capital investment. The drawings has been subtracted, so their capital at the end of the period is 89 178 and 4822. So this completes the introduction to partnership accounting, and if you have any question related to this topic, please email me and inshallah I will reply you back. Happy learning. Thank you so much.